Okay, good day, everyone. This is Joseph Trevisani from Worldwide Markets. Welcome to my webinar. I thank you for coming. As always, it's a compliment that anyone takes time out of their day to listen to me, aside from my children who don't always listen, even though they're usually there. Today's topic is the yen and why its strength after, in the immediate sense, why its strength after the BoJ negative rate increase. How do you have a negative rate increase? The BoJ limited imposition of negative rates is not a mystery at all. In the context of our slightly bizarre world when it comes to bank rates, it makes a reasonable amount of sense. As always, with my webinars, if you have any comments or anything else that you would like to add to the webinar, aside from scatological jokes, please feel free. I will check the chat periodically, and I'll be glad to take up any topics that anyone has, aside from why it's so difficult to fly kites when there's no wind. So let's start. On, well, let's see, how should we, it's kind of an odd topic to approach. You know what, let's approach this from because what you're looking at is something which really should make much more sense to us than to anyone else. One of the, as traders, one of the roles that I play here and many other places is an explainer of markets, both on an immediate sense, why the yen or dollar, I was going to say dollar mark, why the yen or the euro or anything else go up or down on any particular day. But also, what are the long-term macro trends? And how does that fit into what a currency is doing? What are the interest rate trends? All of the macro topics that we deal with. None of these work as a narrative for what happened with the BoJ. BoJ raises, drops some of its rates to negative, not all of them, but some of them, and the yen gets stronger. This makes no sense from a macro point of view. Not the way it's supposed to be. However, from a trading point of view and from a return point of view, it makes far more sense than anyone thinks. And we're going to try and explore why that is today. But just to give you a sense of how often this has played out, I'm going to find a much longer chart here. Here's one. This goes back to 1980. Okay, let me just pull this up for everyone here. Okay, now, I have not been in the market for the length of this chart, but for, unfortunately, more than half. So, you're looking at the yen index here, okay? 100 is here. 108.85, that's the yellow, okay? So I remember distinctly this period back here in the mid-90s when I was trading the Tokyo desk. The yen was down at 80, 85 for a considerable amount of time. Remember the length of this chart. This is about a year period down here. It's a long time. The Japanese economy was doing badly. Property market had crashed. The Nikkei began its long descent. The Japanese were injecting money into the economy every 20 minutes. I exaggerate. Supplemental budgets, everything. Nothing worked. The yen stayed relatively strong for quite some time. There's no good macro logic to it. We saw another example of that here. One of the things that Abenomics was designed to cure, but not just as a cure for a currency rate, but of course because that's supposed to reflect and affect and help the economy. After the financial crash, the dollar yen descended rapidly. The Japanese economy was doing nothing. Japanese interest rates have been essentially zero for 20 years. They've been below 1% for 20 years. 20 years. That's almost a generation. As an aside, as I've said many times before, if you want any proof of why in an industrial economy permanent low rates don't work, just look at Japan. That is not a rate regimen that anyone should want to emulate. So I guess the immediate question would come up, why do the central banks go there? And the simple answer is they've got no place else to go. Central banks are essentially a one-trick pony. It's an old phrase from, I think, traveling circuses, maybe here in the United States and many other places too. It was interesting. I know I talk about my children a lot, but there was reading a Madeline book where Madeline and Pepito were taken by gypsies, and trying to explain that to my children was a little bit uncomfortable because they're only 7. Anyway, central banks are a one-trick pony. Interest rates, up or down, that's about all they can do. Everything else is just a derivative of that. As I said last week, Ms. Yellen's macroprudential regulation is macroprudential nonsense. I can't think of any business cycle or financial crisis that would ever prevented by macroprudential or any other kind of prudential. Since we assume all regulations are prudential, why put them in? Prudential regulation would seem to be a redundancy. So it's bad. Before I get off on the Fed again, let me go back to the yen and stay on our topic today. So trading rates are outside of macro reality, or in addition to macro reality, are hardly a new invention. They're not something that came upon Japan recently. The result, I think they were the result, and I've been making this argument for a number of years, because this is the first time that the topics have come up. The last time I was on the tube, as my children call it, the question came up about yen. What is the yen doing here? Why did the yen strengthen after the Japanese cut their rates? As in this period right here, in 2000, from 2008 on, as now, the reason are largely trading reasons, but not entirely. Let's take a look at another chart here. And I'm going to first talk about 1980 in retrospect, and then I'm going to talk about now and some of the reasons that we have seen. It's not the one I want. Let me just find the right chart. Okay, here we go. Macroprudential indeed. No, good, but imperfect. Here we go. Okay, there we go. Let's check the chat here. Okay, so this is the recent central bank events. None of them have been terribly telling. They're all apparently going the wrong way, except for maybe this last one here. Okay? So what's happening here? The Fed hikes rates, long expected, finally. The dollar gets weaker. The BoJ institutes negative rates. And what happens? The yen gets stronger. No. And then finally we have what I call the Yellen No. I wrote a column about that. No, 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 that Amy Winehouse song, Am I Going to Rehab? No, no, no. And Yellen said, Are U.S. rates going to rehab? I'm quoting myself here. And Janet Yellen says, no, no, no. Moderately witty, I thought. And again, the yen strengthens. Now, the last one makes reasonable sense. And there are two ways of looking at this. But first, we're going to look at the trading position. First, I want to bring up the original 1980. Where's my 1980 chart? Okay, we're going to keep those two down there. Sorry, here it is. Nope, sorry, that's the population. We have population to deal with. Here we go. Okay, let's deal with this one. Dollar yen in the yen at the crash. Whoops, I've got to put this one up. Sorry. Okay, there we go. Dollar yen at the crash. Japanese economy has been tootling along miserably, no inflation, very low interest rates for 20 years. I can show you the chart. GDP going nowhere, inflation going nowhere. Slightly declining population. The yen gets stronger and stronger and stronger through the financial crash and the residue. There are two reasons for this, as odd as this may seem. The first was that the yen was far too weak before that. At least it was driven up by the old carry trade, which we probably all put into our memory. Once the carry trade crashed, you get a stronger yen simply based on trading. And once the yen gets stronger, because you're selling the cross, once the yen gets stronger, there is no attention shifts, speculative interest leaves the yen, and there's no countervailing market force to bring it higher. That's one explanation. And that's probably, there's partially truth to that. What's another explanation? At the time, well, the yen is one of those currencies, unlike the euro probably, that has a secure domestic base. It's not going anywhere. It's like the dollar and the sterling. And for return of capital, the old cliche rather than return on capital, Japan has recently, within the past 10 years, I'll say, turned into an occasional and more than occasional safe haven. People know that if they send their money to Japan, Japan is not going to blow up. In addition, the history of Japan through times like that has been one of a strengthening yen. We've seen it again. So once that notion takes hold in a market, you can say to some degree it becomes self-reinforcing, self-fulfilling. In addition, there has been a good deal of repatriation and ideas of repatriation from China, which I believe Japan is the biggest foreign investor in China. So, excuse me, when things get dicey, when things look difficult, when China started devaluing its currency back in August, you get flows back into Japan. Okay, now what else do we have here? Let's take a look at another one, a much more, a closer one, okay? Okay, here we go. So this is the recent history of Japan. The yen in 212 was there and had stayed down at that level approximately since the financial crash. Let's take a look at this one here. Let me take another one. Okay. This is the yen, right? So the yen is coming down from 110 down to 80 through the crash as the cross is coming down, and then it stayed below 90. And you could actually say below 95, but let's just say below 100 from 2008 on. None of that, of course, makes any sense in relation to the strength of the Japanese economy. None of it has anything to do with where the Japanese government wanted the yen, up at 124, 125, above 120, another 20% weaker. So it's clear that market forces prevailed. We have some of that effect here. So my explanation for why the yen came down, or why the dollar yen came down, partially relates to the chart you're looking at right here. Look at those two lines. Well, you can do 110 and 116 or 115. Those are very tradable charts, and everybody knows this. The yen has gone from 80 to 125. And how does it get there? We all know how it gets there, and I'm not trying to be facetious here. But what happens lots of times, to my understanding in markets, is the simple things which end up providing a lot of the rationale and the reason behind many things tend to get forgotten. This means that there are a lot of people who need to sell, especially from here on, from 2014 on, with this very rapid ascent here and then this long, prolonged period up there. So the first issue you have is that the market is looking for a trigger to take some profits. So how would a BoJ rate hike fit into this? Well, the BoJ isn't the only market out there. It's my contention that the far more important player at this time was the Fed. The Fed hiked rates and then issued its prediction. It's not calling it that, but the market utterly took it as a prediction. We're going to raise rates 4 times in 2016. The Fed's been back with maybe two speeches through in mid-March from Dudley and Lockhart, if I believe, the New York and the Atlanta Fed presidents. The Fed's been backpedaling ever since because the U.S. economy and U.S. statistics are not looking good. And I know, and every time I have this discussion with people in the market and with economists and with journalists, they all come back with the same thing. Well, the labor market is good. But the labor market, two things. One, the federal jobs numbers, the most massaged numbers out there. All done for statistical reasons. Nevertheless, they are the most massaged job numbers out there, too. They're the only statistic that anyone can quote that looks remotely strong. And remember, the categorization of a lot of the Fed statistics, or at least the jobs that are in the BLS statistics, a lot of those jobs are part-time and low-wage jobs. So although it looks good, when you look at consumption figures and when you look at wage figures, there's nothing like that. So anyway, the Fed has been backpedaling since that December hike on its rate hike. We're now down to 2. It looks like there's a very good chance, certainly the Fed futures are saying so, that there's less than 50% chance the Fed is going to rate hike rates at all this year. So where does that leave us? So we have the BoJ hiking rates. So what does that mean for the rate picture? No rate picture is on one side or the other, is only exclusively one side or the other. So from a Fed at the turn of the year, which is only now 4 months ago, it's going to hike rates 4 times, where the market judgment is it's going to raise rates no times. And there you have, I think, the most important of the effect on the dollar yen and why the yen is actually strengthening. Because the variable, the more important variable between what the BoJ is, if you're looking for macro reasons for what the BoJ is doing, what the Fed is doing, is the Fed. The BoJ's imposition of limited rates did have its initial effect. I mean, if you look at that here, you got a spike in the dollar yen, and it's done nothing but come off since then. And the initial reaction is the reaction you would expect. Negative rates, lower rates, sell the currency. But in and upon consideration, the Fed's change in attitudes is far more important. And I think this is the market judgment that you're seeing more than anything else. You also have, during some of this period, some stirring. I mean, the initial decline over here has a good deal to do with, it appears anyway, at least it's coincident in time, with repatriation from China. So of the potential effects, and you also have, of course, here, the movement, and look at that sharp movement in there through 116 and then briefly through 110, where it has stayed below 110 since then. So you have, as far as the market goes, just trading. Market ripe for profit taking. You have two central banks, one of whose rate policies is probably more important and is more of a surprise, perhaps, to the market than the BoJ. And one of the reasons are, look at this. Let's take a good long look at Japanese rates. Let me just find it here. Okay. This is a chart of the Japanese overnight call rate, which is the white. Fed funds rate, which is in yellow, and the dollar yen rate. And this tells you what's more important, my prior point, for Japan. It's clearly the Fed funds rate. Because the Japanese rates, now here you have a coincidence where generally, in rough terms, of course, the Fed is raising and the Japanese raise a little bit. But for the rest of the time, the Japanese rates are incredibly low and the Fed's rates vary, and you get a much closer correlation between what the Fed is doing than what the BoJ is doing. And the reason is quite simple. Historically, the Japanese rates have been nowhere for 20 years. And the degree the Fed raises, the Fed gets up at 6%, then it goes down to 1%, then it goes back to 5.25%. At the entire time, the Japanese rates are generally below half. So there isn't any great variation going to happen in Japan. But you get a 4% variation, 4.25% variation, 4.25% variation in the Fed funds rate. So clearly, markets are going to be paying a great deal more attention to what the Fed funds do than to what the BoJ does. And then this is, I mean, you don't really see it when journalists talk about the immediate macro supposed events that are happening that should, but it's a lazy logic. It makes for easy copy. It makes for the kind of narration that journalists like. I'm not absolving myself from this. I'm functioning as a journalist, even though I'm not. I mean, I'm not getting paid to be a journalist, of course. I'm getting paid to be an analyst. But it's a lazy explanation. And when the alternative explanation becomes very difficult, convoluted, sometimes hard to prove, certainly hard to track, it is almost inevitable that the journalists will go with the easier explanation. I think I've told everybody this before, but during the 2008, 2009, 2010 period, when the yen was very strong, made zero sense to anybody who was looking at rate differentials. I tried this explanation a number of times. I used it a number of times in pieces that were published quite widely out on the web, and on various types of media, talking to journalists and also appearing on television with this explanation. But the explanation never really went very far. It never really caught on. It's too difficult to put into a storyline. So you're left as traders reading the news with a puzzle, which is nobody bothers to explain. Now there are, and I'm not being completely critical. I mean, I have an article right here from the Journal on April 13th. And it's pointed, and then the subheadline is negative interest rates appear to have backfired on Japan. Now, backfired meaning, of course, that they didn't achieve what the Japanese wanted to achieve, which of course was to lower the Japanese, the rate of the yen. But it doesn't really give you a very good explanation as to why this is. So first of all, we have markets, okay? Markets are ripe for taking. Two, we have interest rates. The BoJ is the marginal player. And why is it the marginal player? Because it hasn't done anything for 20 years. And there's zero credibility that it will, one, do anything, or two, have any effect when it does. Now, you say, well, what about the gain in the yen for Abe's election? That's a good answer. That's a good question, and it has to be addressed. So you have some of the same effects there. One, the market was ripe for profit taking. I'm trying not to repeat myself here, but this tends to be true in trading markets. The yen had been down there for so long, and that it clearly wasn't going any lower. You were ripe for a move. One. Two, Abe sold this as a dynamic, forward-looking, different policy from before. In the time, 2012, you're getting Mario Draghi, whatever it takes to save the euro. We're getting essentially Shinzo Abe, whatever it takes to revive the Japanese economy. The market's bought it, despite the past history. It hasn't really worked. Nevertheless, they bought it. It hasn't worked in the sense that the goal of devaluing the yen was not solely to devalue the yen and get a nicer trading rate and to give all of us a good trend to trade. No, the purpose was to revive the Japanese economy, which by and large has not worked. As people have said many times, there's never been a country, history of the world, that revived its economy or promoted growth long-term, even medium-term, by devaluing its currency. It doesn't work. It's seductive because it can often be achieved. It seems to make immediate sense, but it never works. Economies are driven by internal factors more than external factors, and the internal factors are far more powerful. Okay, so we have a reasonable explanation as to why the yen did not weaken when Japan lowered interest rates. And part of that, of course, goes back. We have trading. We have the Fed's far more important change in rate policy. And we also have the Japanese BoJ credibility, which is relatively low, shall we say. I remember when I was sitting on trading the Tokyo market for a money center bank for Credit Suisse, actually, in the early to mid 90s, when the yen was also here. Remember, this is the yen rate right here. We got 92 here. You've got the yen rate down around below 85. Japanese government, Japanese central bank did not want it there. And every day in Tokyo. Not every day, but very often they would come in and they'd sell the yen. That was great. Because what do? As soon as traders sitting on a bank, prop traders, and also making prices for the market, what happened? Well, we went with the BoJ. And then as soon as they stopped, we went the other way. So it really never accomplished what the Bank of Japan wanted it to accomplish. Okay. I can deal with this at another point, but I can't cover everything here. So we have a lack of credibility on the Japanese bank's part. In addition, there does seem to be, by admission and also I think by distortion and by fact, a limit to what a bank can do. A central bank cannot go to negative 10% interest rates. The distortions would be astonishing. It would wreck economies. The distortion and the inability of an economy to be revived by permanent low interest rates must be evident to the Bank of Japan. It must be evident to governments that this doesn't work as an economic policy. The distortions are vast. And it prevents, it's happening here in the United States, it's happened in Japan for 20 years. It prevents the catharsis of capitalism, which is a necessary aspect of the system. It is one which, unfortunately, central banks have taken it to mind that they need to prevent. But that's another topic. Back to the end. Let me show you another. So you get this, and let me do a slight digression, which is actually on the same topic. You would think that at negative rates, central banks would be unable to sell their debentures. I don't know if they're actually debentures, but I kind of like the term. Their notes, their bonds, their JGBs, the German Bunds, the American, we're not quite there yet, treasuries, gilts. Gilts are not quite there yet either, and all the other stuff, which hasn't turned out to be the case largely. There's still buyers out there. How could this be? Well, let's take a look. We have the JGB2. And this is something we have to remember when you hear the macro, the macro narratives out there. Just get on my list. I'll mail you my stuff, so you don't have to listen to only the macro narratives in the mass market. Actually, this is not the one I wanted to show you. One sec. I want to do that. Oh, I closed it. I can't believe I closed it. Sorry. Okay, we'll have to deal with this one. Okay. Okay, this is the the Japanese inflation rate is, no, I'm sorry. The yellow here is the overnight call rate, Japanese central bank rate. The white is the yen, dollar yen, and this is the most important, the green is year-on-year inflation. So you ask, how can anyone be interested in a bank account or a government security that returns that you have to pay to get your money back? Well, the first is, obviously, it depends on risk. And if you fear that your alternatives are worse, then in a relative world, remember, there has to be an alternative. You can, of course, and the alternative is, now, the alternative we have to remember, with negative rates, the alternative is not only a particular government security someplace at some other or not, what's this chat here? Hold on, folks. I'm just looking to see what's around. Okay. The alternative is not only just an alternative government investment, investment of some kind, some sort of very secure investment. The alternative is now cash, at least as far as negative rates go. But it's not really. Not for the government bond market. For you and I, if we want, if you know, our bank just said, well, you want to keep money in my bank, I'm going to charge you 5% a year. We'll say, get lost. Well, I'll take it out in cash. But again, it depends on how much money is involved. You may not feel uncomfortable at having $10,000 in your house, but you might very well feel uncomfortable at having $1 million in cash around your house. In addition, it takes up a lot of room. Where are you going to put it? The where to put it problem is far worse when you're talking about billions of dollars in government securities. So there really isn't any alternative, any cash alternative. Now, there is an alternative of money market rates and things like that. I don't know where those are in Japan. My guess is they're close to negative or negative depending on the duration. I didn't look them up before I came in simply because there are only so many places a money market fund can invest its money in. If you're getting a negative return, that's what your customers are going to get. So, but the fact is the biggest determinant is not the absolute. The biggest determinant, the only determinant really for this kind of question is comparative. And this is where it gets slightly interesting. Remember, yellow, interest rates. Japanese, I'm sorry, and green, CPI. So let's think about it. If we just take the current situation, the immediate Japanese, and we're just doing this in a representative fashion. If the rate is negative 0.1% and the inflation rate is 30.3% year over year. So what's your cost? It's negative 0.31% a year. You lose because of the inflation rate and you have to pay a little bit. So let's just say as a thought experiment, that's what you're going to get on a 2-year JGB. It's not correct, but the idea is correct. Let's take a run at US, say the US 2-year. US 2-year, and that's the chart I closed, I'm afraid. It's my apologies. Point negative is 0.75%. US inflation is, the PCE is about 1.3%. Now that's, is that headline? No, headline PCE is 1.7%, okay? So you're getting paid 0.75%. You're losing 1.7. Let's just make it easy. 1.75% on inflation. What's your return? It's negative 1%. And that's why negative rates haven't dimmed interest in bonds as much as you might think they would. The comparative return in that example I just gave, negative 0.31%. Of course, this doesn't take into account currency transactions. Okay. But just as a comparative, rates are so low that in the US, they do not compensate for inflation. They certainly haven't compensated for inflation in the period before oil prices took their tumble. You were losing in the US on the inflation translation for government bonds at certain durations. And for some of that period, the Japanese prices were deflationary and the yen was either strong or strengthening. You could actually have a better return on your money from negative rates, comparatively speaking, to positive rates, depending on the variables. So what's been more damaging actually to the Japanese, or more dangerous for the Japanese government bond markets, and to some extent here in the United States, and the Europeans are running up against this as well, there isn't anything else to buy. The BoJ is monetizing almost the entire Japanese budget deficit every year. As Herbstein, that famous quote, which has come up more and more the past couple of years, something that can't go on won't. At some point, investors will lose, or somebody, I assume it's investors, will be unwilling to risk anything in the Japanese government bond market. So, but if all the bonds are being bought by the government, does it matter? It's a very good question, and one we do not have the answer to as of yet. But, so we have the market logic. We have the change in central banks. We also have answered why it is that even with negative rates, you can make a case, a very logical case, for buying those bonds. We're certainly seeing it in Europe. Now, there are many other, there's a major factor involved here, of course, and that's whether markets consider that the US is still the safest of all destinations when things get unpleasant, and I think that's probably true. But nonetheless, from a simple comparative point of view, you can see, it's a good thing I spoke about that because I just unfortunately ended it. Okay, this is the inflation and currency. I'll just show you this for a second. Okay, come on, here we go. Okay, there we go. This is from 1980 on, the yen rate and the Japanese inflation rate. And you can see there's a relatively, there's not a lot of correlation here. The correlation, the mild correlation that does exist, I mean, from this period here, now remember, back in 1985 and all of these periods back here, there is some correlation, and it's a correlation you would expect because it is a correlation through central banks. From this period on, and I have another chart that I'm going to bring up to show you this, the correlation weakens because central banks are relentlessly manipulating rates. They broke down the relationship, which was fairly normal. I mean, before the great central bank experiment of after 2008 and the financial crash, the year in, year out, decade in, decade out, the most important correlative for currency trading rates are central bank rate cycles. That has now broken down, as you can see. And it is far less what the rates are than what the market thinks rates may or may not do in the future, and many other factors. The simple comparison between rates and who's going up, who's going down seems to have broken down. Okay. Let's take another aspect of the yen. That's not a particularly helpful chart. This one is. Okay. Now, we're going to look at this briefly because it doesn't have a lot of direct market application that you can point to immediately. And to talk about it, and this is another factor, I think, in the currency, which also accounts, certainly recently, I think, and in a general long-term sense, for the potential strength of the Japanese currency. Now, this is a part of Japanese population projected. I was curious, and I don't know. And I put up this chart and I looked at it. I said, "What is this bump here?" In 2010 or so, there's a bump up, and I don't know what it is. And I didn't have time to look at it. It doesn't fit with the whole chart. Suddenly, the Japanese trend and populations are the longest term trends and the most stable of trends. They're sort of the quintessential Isaac Asimov psychohistory trend. A long-term movement in masses of populations comprised of individual decisions. Decision whether or not to have children is extremely intimate, very personal, and has the most dramatic effects for a culture and a country's future. But there's almost no way to categorize it from a response to only an external stimuli. I'm getting a far field of this, so I'm going to drop that one. But at any rate, one of the other effects that you will have as a population ages, the people who spend are not generally the elderly. They are younger, middle-aged people raising children. The child-raising years are probably the years where a family unit spends the most. I'm entering into that period right now, and more I can tell you, it is definitely true. The family budget takes a few twists, which one had not experienced before, and so there you go. But what does happen? Spending declines, and the amount of money spent on healthcare as you age does not make up for the amount of spending. So, with this population graph, the red line, of course, is the end of this year. You can only get these statistics yearly, and that's the projection. The natural inclination is deflationary. At least it's disinflationary. If people are less inclined to spend for any reason, but it's a culture-wide phenomenon because of the aging aspect of the culture, then you have deflationary pressures in the economy. And this is something we've seen in Japan and here in the United States for the past 6-7 years. The Fed's been pumping all sorts of money into the economy. Got to get inflation up to 2%. Every year, every quarter, they say the same thing. We are confident that inflation will return soon, sometime, to our 2% target. Well, it hasn't really yet either, until very recently. All of the money flopping around, sloshing around, wandering around the economy has not created inflation. Well, why not? Same in Japan, same in the United States now, though to different degrees, because the demand is not there. The monetarist equations are much simpler than they should be, at least than we've learned that they actually are. Demand is the other essential to the inflation and the money supply equation. Japanese demand is slowly ebbing because its population is aging, and aging rapidly. Japan has one of the lowest birth rates in the world. I am not going to venture what this means for a culture or why this happens within a culture. I have my own ideas about this. I'll just say that there's a famous line, I think it's from Arnold Toynbee, the historian. It's that cultures don't die, they commit suicide. I don't know what it means, but it is an observable fact that we've never experienced before. I've said this a number of times before in various contexts. It's an observable fact that we've never witnessed before in an industrial society, and we are now going to witness it all at a rush in many places around the world within the next generation. What does this mean for a culture? But we know what it means for price levels. Less demand means falling prices, or at least it means that the pressures are on the falling prices. Well, if because of lack of demand in Japan, prices fall, that has a translation effect to the yen for a strengthening yen. If, you know, if an iPhone at one point cost 600, say 60,000 yen, and because there are fewer buyers, it now costs 50,000 yen, this has an effect. And the effect is deflationary. And the translation effect, the yen is more valuable. If fewer yen to buy an iPhone, well, if you go into Japan and then buy an iPhone, you get a stronger currency. So behind the central bank interest and central bank interest rate differentials, the changes in central bank policy, we're talking about the Fed, and the trading influences for the Japanese yen, you have this basic differential in prices coming out of Japan's socioeconomic environment. So let me take another look at another chart here. Hang on. That's the one we just put up. Let me do this one. Okay, this one's not quite as descriptive, but I think we're going to use it briefly anyway. Hang on. Come over here. Come on. Oops. Okay. Now this, I couldn't find a good chart for the Japanese population going, at least on Bloomberg. These charts are all Bloomberg, by the way, going back before 1980. And this chart doesn't show except in the curve in the back, a very profound influence or relationship between CPI and population. You could make some sort of argument that right here, as the population really begins to tail off, you get a drop. But this chart is not giving you a close enough correlation, but I just wanted to show it to you because when I have it in two, I thought it was a little interesting. Okay, let's do one more chart, and then we're going to take a view. Yes, this is the one I wanted to show you. Okay. Okay, this is, and then we're just going to summarize and end because I know we end after an hour. So this is a chart for CPI and the yen, okay? The yen is in the yellow, CPI is in white, backed by blue. And what has happened here is that the boost in inflation that Japan witnessed from about the first quarter of 2013 until midway, 3/4 of the way, a little bit more through 2014 is based on what? Based on two things. One is a base effect from earlier. Remember, this is year on year. But more importantly, it's based on the expensiveness of imports into Japan on the falling yen. That's the price effect, the sort of the macro market effect of the same thing of the Japanese, of a similar effect to the Japanese population. Yes, the dollar yen went up. The yen went down. Abenomics did succeed in devaluing the yen an appreciable amount, close to 50%. At one point, I think it did reach 50%. And that drove a large increase in CPI. But even though the yen managed, at least even at 108, it's a lot stronger than 80, which is where it started from, approximately. Prices, and you get the same effect if you look at core prices, have fallen dramatically. That kind of exchange rate induced price manipulation is doomed to fail unless it revives the economy and revives demand, which it did not. Those types of translation effects don't last. And you can see this right in front of us. So we're right at the end here. Just to summarize what we've done, what we've said, or what I've said at least so far today. The strength and the strengthening of the Japanese yen after the BoJ rate increase is based on a number of factors. The first, the one I would warn everyone about, is ever since the financial crash and the enormous introduction and unending introduction of central banks' zero rate policies around the world, we are living in a different world, and the correlations are not necessarily what they were. Two, the market was, that's a general statement, of course, the market was primed to take some profits on a weekend on a strong dollar, and that it did. Three, the central bank relationship that has been most important for the dollar yen is not the relationship to the rates of the BoJ. It's the relationship, this is the dollar yen we're talking about. It's the relationship, and the only reason I'm not covering as much of the other currencies and the other Japanese pairs is simply because there's too much material for one webinar. The most important relationship for the Japanese yen is not to the BoJ, it's to the Fed. And when the Feds, remember this chart right here, okay, let me just put this one up here. Okay, there we go. And when the Fed, after its rate hike, started backpedaling and US statistics started to deteriorate, that was the key point, I think, and the key piece of information coming out of the US and the Japanese economy, primarily the US economy, that mattered. As US statistics throughout this year have deteriorated, it has become clearer both in the market's own assessment, the Fed funds futures rates, as to what the Fed can do, and thence a delay by the Fed's own admissions. And that is more important to the dollar yen rate than anything the BoJ has done or, frankly, is likely to do. Okay, folks, I thank you all for listening. Once again, I hope this was some sort of elucidation, fancy word for help, with your trading and also with some understanding. We'll be doing another webinar. We do webinars with FX Street. I'd like to thank Mauricio and Adinda for their help. Every Monday, at the same time, 11 o'clock New York time. I have not decided yet on this next week's topic. If anyone has any questions or a topic that they would like, please let me know, and I'll be glad to consider it. We did do gold last week pretty much at everyone's request. Okay, I will put my email up there. And I hope to see you all again next week. Thank you very much for attending, and everybody have a great day.